Hello, friends. Once again, welcome to my EDR series. You know what is EDR? Everyday revision. Those who have been observing, those who have followed in the past, must be very clear about it. Those who have by chance come across this, the whole idea of going through EDR is what everyday revision. What happens is the time gap between what you learn and when you revise, in between the concepts fade up, and what happens is you find it very difficult to study because you just want that push. Okay, somebody would just quickly tell me the concepts. No, I will again sorry, I would again quickly revise the things. So there I am, your friend, your philosopher, your guide, your teacher, CA Sandeep Neve. Through my YouTube channel, I want to do this a quick revision for you all. So, friends, if you have already subscribed, great. If you have not yet, please do that and forward to all your friends who are doing CA. It would be very helpful in their journey, right? So, today, without wasting time, let's start, guys. Because yes, we need to keep it small, right? So that your attention span remains, you don't go away. Capital structure theories is what we are going to revise. Let's reconnect that capital structure topic is connected with cost of capital. What we try to do, we try to study the impact of capital structure on what cost of capital, and then there are diverse opinions. Some people are of the opinion that yes, if you change capital structure, what will happen, the KO will change, and if you some people say no, KO will not change. So if some change, according to some people, change in capital structure leads to what, changes in KO, and according to some people it doesn't lead to any changes in KO. So, which theories we study, people? Variable KO theories, we study net income approach and traditional approach. And in constant KO, we study net operating income approach and Modigliani-Miller approach. Okay. Obviously, people, as we had discussed earlier, everybody who writes their theories, they come up with their own set of assumptions, isn't it? So here also we have certain set of assumptions, very interesting assumptions. See, only two sources of funds, debt and equity, no preference. Whatever change you bring in capital structure, assets are not going to change. You remember we had done this like, okay, if you are realistic, if you are unrealistic, and this is realistic. Whichever way you raise the money, whatever assets you buy will remain same. Correct? Okay. EBIT will also remain same. Because see, we have discussed this, that you may arrange money from debt or equity or whatever. Your sales, your variable cost, your contribution, your fixed cost, nothing is going to change. So EBIT will also remain constant. Yeah, very important assumption. All profits are distributed. So no retention. If no retention, people, in cost of capital, what did we study? That G is equal to B into R. Yeah. So out of that, if the retention is nil, then the growth is going to be nil. Operating risk remains constant. Why operating leverage? Bacha, operating leverage is contribution upon EBIT. You do any change in the capital structure, neither contribution is going to change, nor EBIT is going to change. So that's why even operating leverage will also remain constant. No taxes, but later on this assumption was relaxed, and KD less than KE. Okay, which is very realistic. See, if KD, which is contractual and fixed, if it becomes higher than KE, who will buy the shares? Who will take the risk of buying equity shares? Okay. So we derive some common formula based on it, people, right? EBIT minus interest directly dividend, because nothing is in there in between. Okay, we make changes in our formula. We say KE is going to be dividend upon E, and we do all these variations. Okay, anytime you feel okay, I want to go through this formula again, you can pause the video and you can see that. Correct, people? Yeah. Let's maintain our motto to finish the revision very fast. Okay. Then we do for KD, we arrive at dkd as I, or d is equal to I upon kd, and then we arrive at ko as what, interest plus dividend upon d plus e. Interest plus dividend becomes EBIT, and v is what, value of debt plus value of equity, so value of the firm. And people, our favorite dialogue, we co, not budget than 3, we co EBIT. Correct? Yeah, so we always remember this, we co EBIT. And if you can remember this, then you can always make as required. Okay. Yeah. And if there are taxes, then what? Multiply EBIT just by 1 minus tax to make it a net value. Fine. Now let us understand the capital structure theory, net income approach. People, we just now discussed the common assumptions. Now a specific assumption. Okay. Here, what is this specific assumption? It is simply the behavior of the equity shareholder. Here, the equity shareholders are like, okay, you want to bring in more debt in the capital structure, bring it on. I am not affected. I don't take it as a risk. I don't mind you bring more and more of debt in the capital structure. So because of his behavior, what will happen, people, KE will remain constant irrespective of proportion of debt in the capital structure. Very, very, very important. And you remember what we had proved, that even see the proportion of debt is increasing, KE has remained same. No change in the KE 20, 20, 20. What is the impact? The KO has gone down from 20 to 16 to 18, from 20 to 18 to 16, correct? So if you put it in the diagram, it looks like this. Remember, correct people? That is what is a simple net income approach. Now let's talk about traditional approach. What happens in traditional approach? Here equity shareholders are little different behavior. Initially they are very smart, very daring. They say, yeah, 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 you bring whatever debt you want to bring. I am not worried. But then you know what happens later on, after some time they get scared. Yeah, so if you actually compare the previous one and this one, the first two examples are same. Here there is no change in K, that remains same. But when the proportion of debt from 0 to 20, till here they're like, yeah, yeah, we are very brave. But from 20, when it becomes 40, they're like, oh, sir, tension, sir, nahi hota, sir, bahut zyada hai, sir. So are they going to leave the business? No, no. They say, okay, you are bringing more debt, zero worries. I am feeling the risk, no, so I should be rewarded. So instead of 20, how much I want? I wanted 25, and then because of that, see, the KO has made a U-turn. So what happens over here, people? After certain time, because of this behavior, KO initially falls and later on it starts rising. Correct, people? Yeah. Okay, and then the next one is the constant KO theory, where we say net operating income, where the equity holders are more like Jugadu people. They say, no, sir, what to do? What you do is you bring in cheaper debt, no problem. You bring cheaper debt. You're saving some cost. Pass on the benefit to us. Exactly the difference you pass on to us. So what will happen? The overall KO will remain constant. You remember how we had done it in our class? First, we had copied this 20,000 over here. Then we found this as a balancing figure, and we found this as the balancing figure. Remember, this is what we had done. Okay, so because of this, what is happening, people? KE from 20, it increased to 22.5, then it increased to 26.67. But what you notice in KO, you calculate again. KO will come 20% only. Understood? So what they are trying to do, they are just telling the management, okay, fine, you are bringing cheaper debt, bring, no problem. But do one thing, whatever cheaper debt you are bringing, whatever benefit you are getting, you pass on the benefit to us. So we will be getting higher KE, and your cost will also remain constant. And then if you go with the diagram, it will look like this. Right, people? These are the three theories. Yeah. Modigliani Miller, very important. Yes. Yeah. So Modigliani Miller, see, they are not proving any separate approach. They are saying, yeah, we follow NOI. We respect constant KO. We have our own concept to prove. Okay. So what they want to prove, they want to prove one very important concept. They call it arbitrage. Now, what is arbitrage in simple words, people? You purchase at a lower price and you sell it at a higher price, and you make some profit in between. Is basically what you try to explore the market imperfections. See, as a customer, as a retail customer, I also know that I can go to wholesale fruit market and get the fruits almost at a half the price. Are Baba. But in a family of 3 or 4 people, I would buy a dozen of a banana, no, at the most. I would not buy a truckload of bananas, dear. I know that's a limitation. And then what every retailer does, he goes to the market, he purchases a truckload of bananas and he sells me one dozen at a higher price. And then I have to say, okay, bye, I have no choice since I can't buy a truckload of bananas. You give me 6 bananas or 12 bananas. Same, right? People here also something very similar, that market imperfections exist and the investors are smart to buy at a cheaper price and sell it at a higher price. Okay. So what is the constant KO approach? See, people, VICO EBIT. So V is equal to EBIT upon KO. EBIT always remains constant irrespective of capital structure. And what about KO? As per NOI approach, KO remains constant. So V remains constant. So what Modigliani Miller are stressing, they say that, sir, whatever happens, no, KO is going to be constant, EBIT is going to be constant. So value of the firm should remain constant over the long period of time. But sometimes, like, there are some market imperfections. Because of that, the values are not same. Okay, let's tap on it. If the values are not same, we will sell what is overvalued and we'll buy what is undervalued. Remember? Yeah. So see, the scenario goes like this. Overvalued firm, down, going down. Shares are sold, value starts falling. Undervalued firm, what happens? Value starts rising. And at one point of time, what happens? Value of both the firms become same, and that reaches a point of equilibrium. This is the whole idea. Okay, he makes a very specific assumptions, people. Okay, he is a follower of I know. That's why all general assumptions of capital structure theory will also apply over here. Okay, very, very nice. Individual shareholders get loan at the same rate of interest as that of company. Why? We had discussed this in class. Let's see, if I go to buy, if I go to borrow, and if a big company like Tata or Birla or Ambani's go to borrow, they will get loans at a much cheaper rate because they will take a loan like huge, running in thousands of crores. Then, sir, why this assumption? All theories always have some unrealistic assumptions. If I don't assume this, and if there is some rate difference, then I won't be able to prove the theory. No brokerage, sir. Where the no broker? You tell me where there is a no brokerage. I will also go to that broker only. There is nothing like no brokerage. But while proving the law, we assume, okay, no brokerage. So I sell these securities, I buy that securities. I sell this and I buy this. In between, the values of sale and buy is equal. No friction in between. But when brokerage there, what will happen? Whenever I sell, I have to pay brokerage. Whenever I buy, I have to pay brokerage. So to maintain that flexibility, they assume like this. Okay, investors are rational and willing to make arbitrage profits. I don't know what time you want to watch this video, but see, people, suppose assume right now trading is happening. I am willing to make the profit, but is it possible for me to make the profit? No, not possible. So we assume that wherever the investor sees the opportunity, he taps the opportunity. Okay, yeah. And equity shareholders of levered company is responsible for debt of the company. Correct? Very simple. It's a fact. Okay, and he is used to taking that kind of risk. Okay. Right. So people, what is very important? See, overvalued firm, undervalued firm. See, if overvalued is levered, then what we will do, we'll sell the levered and we'll buy the unlevered. So if overvalued firm is unlevered, then what we will do, we will sell the unlevered. If the undervalued firm is levered, then we will sell it, and then then we will buy it. So what is the simplest thing that you should remember? Whatever is overvalued, that you sell. Whatever is undervalued, that you buy. That is the simplest thing that you should remember. And one more thing you should remember: whenever there is a question on arbitrage, first, for both, they will always give you two forms in the question, and then they will tell you show the process of arbitrage. So whenever this happens, no, people, what you should, the first thing that you should do, you should find values of both the firm. Arbitrage process can start only and only if what? Only if one of the firm is overvalued and the other firm is undervalued. Clear, people? Yeah. Okay. So in the long run, what is going to happen? As we discussed, value of the firm will become same. So what say that if the taxes do not exist, value of levered firm will be equal to value of the unlevered firm in the long run. But yes, we know that if the taxes exist, levered firm is always having some benefit, and that benefit has been quantified by as what? Debt into tax rate. Why debt into tax rate? We have discussed in the class. It must be there in your notes, right, people? So this was a quick revision of the concepts. Before I stop this video, I'll again urge you, please share this knowledge with all your friends who are doing CA. Share with them, you subscribe, you follow, and please ask everyone to do the same thing. Thank you, guys. See you once again in such a quick revision where we quickly revise the things. Anytime you need the notes, you can just stop the video and take the screenshot of this. Thank you, guys. See you soon in the next EDR.